Hi, my name is Katie Healy and I'll be doing the ratio analysis of Sprint. Financial ratio analysis is an important part of strategic management, and looking at financial ratios throughout the year, as well as looking at the competition, is going to help us identify some strengths that we can build upon and also weaknesses that we can address. There are four ratio types, as you can see in the picture. There's liquidity ratios, leverage ratios, activity ratios, and profitability ratios. We're just going to go over a few of each. The first, we'll start with our liquidity ratios, and we'll start with the current ratio. This financial ratio indicates where a company has enough short-term assets to cover its short-term debt, and a ratio between 1.2 and 2 is pretty sufficient. Over the past 5 years, as you can see in the yellow box, Sprint has had a steady current ratio. From 2010 to 2014, they had around a 1.2 current ratio, which is good. But a red flag to me is that the current ratio for Sprint has declined over the years. In 2015, their current ratio was 0.89, which is a decrease of 0.3 from the previous year. In relation to the competitors, Sprint and T-Mobile are similar because they're smaller telecommunication companies, and AT&T and Verizon are much bigger companies, so their ratios are a little bit skewed. Both have very low current ratios. It doesn't necessarily mean a bad thing. Sprint's current ratio is significantly lower than T-Mobile's, as you can see in the blue box. T-Mobile's was at 1.56, and this is much better than Sprint's and can possibly imply that T-Mobile just can pay off their current debt better. The next ratio we're going to talk about is the quick ratio. Is a strong indicator of whether a firm has sufficient short-term assets to cover its current liabilities. And companies generally do not want a low quick ratio. When it's lower than 1, it means that they don't have liquid assets to pay their current liabilities, and those should be treated with caution. As you can see in Sprint's, their quick ratio in 2015 was at a 0.76, which is significantly lower than the previous year of 1.1. This ratio wants to be around 1, but it's not a good thing that it's continually decreasing. In comparison to the competitors, Sprint has a much lower quick ratio than T-Mobile, but not Verizon and AT&T. T-Mobile's quick ratio was 1.4 for 2015, where Sprint was at 0.76. AT&T and Sprint are more diversified and have more landlines in their companies, so that might explain why their quick ratios are way lower at 0.5 and 0.52 respectively. The next ratios we're going to talk about are the leverage ratios, starting with debt to total assets. The higher this ratio, the more leveraged the company is, which also goes with greater financial risk. Sprint's debt to total assets ratio over the past 5 years has been a steady 0.7. Because it's less than 100%, this means that Sprint has more assets than debt, and that means they're not highly leveraged. Because competitors have a similar debt to total assets ratio as Sprint, this might make Sprint look fine in the category. AT&T was at 0.69 and Verizon's was the highest at 0.93, and that might suggest that the industry just has stable cash flows. The next is debt to equity. Sprint's debt to equity for the past 5 years has generally ranged between 2.5 and 3.3, but with the exception of 2012, which was the year that Sprint really declined. With a constant debt to equity ratio over the past 5 years, it seems that Sprint is using their debt to finance their growth, but not in an overly aggressive way. I looked further into the finances and looked into their cash statement, and it showed that Sprint in 2015 was really spending a lot of money on investing, especially in property, plant, and equipment in 2015, so that might explain why their debt to equity ratio is where it's at. In comparison to the competitors, Sprint has a higher debt to equity ratio than T-Mobile and AT&T, and that might indicate that they have way more debt. Verizon's debt to equity ratio is much higher than the other competitors at 6.31. That sounds really bad, but because Verizon is really highly leveraged, that might mean it is a little skewed. The next ratios we're going to talk about are the activity ratios, starting with total assets turnover. This measures whether a firm is generating a significant volume of don't put that in there. By looking at this ratio, I concluded that each company in the industry has a similar number, around 0.5 and 0.4. Generally, a higher total asset turnover is better because it means the company is generating more revenue per dollar of asset. The similar ratios from each competitor tells us that a low turnover ratio is somewhat normal for the telecommunications industry, and this is due to the large asset bases that would yield a lower asset turnover. When looking at Sprint over the past 5 years, though, it shows they had around a 0.6 for the total asset ratio before 2013 and 2014, where it plummeted to 0.19 and 0.09 respectively. And these 2 years were really bad years for Sprint financially, so seeing that ratio go back up in 2015 is a good thing. Next is the accounts receivable turnover. In 2015, theirs was 24, which means that 24 times in a year, Sprint is able to collect all their receivables. In previous years, it was at a steady 34 before 2013-2014, where it skyrocketed up to 72 and 167. In comparison to the competitors, Sprint had the third highest ratio. Verizon and AT&T were at the top with ratios around 40, and this is a really good number, and it might be due to a combination of a conservative credit policy and an aggressive collections department, as well as high-quality customers. T-Mobile and Sprint have lower ones, probably due to poor credit policy, or might even just be because they have a lot of customers that have financial difficulties. Next are the profitability ratios. We'll start with gross profit margin, which in 2015 for Sprint was at 0.45, and this margin over the past 5 years for Sprint was around 0.4, which shows the stability. You want to be stable with this ratio, so it's good that Sprint's margins are not fluctuating much year to year. The bad thing is that their margins are only at 40%, and getting that number up would be a really good sign for the company. Verizon had the greatest gross profit margin at 0.6, so 60%. AT&T and T-Mobile's were both around 5. All four major companies were close in this margin. Verizon had a much higher, Verizon might have had a higher gross profit margin because it's larger and more efficient. Next, we'll talk about the net profit margin. Sprint's profit margin for 2015 was at a negative 0.09. This is a really bad margin considering that means that they make negative 9 cents per dollar of sales. Over the past 5 years, Sprint has had a negative net profit margin, and most companies have low margins, but not negative. Negative is a really bad sign for any company. Verizon had a really high net profit margin at 0.14, so 14%. AT&T was at 0.09 and T-Mobile was at 0.02. Again, those numbers seem really low, but that's normal for any company. Last is the price to earnings ratio. In 2015, Sprint had a negative PE ratio at negative 4.26, as you can see in the yellow box. This is really not a good sign because that means that investors are not going to be willing to put money into the company. Verizon's PE ratio in 2015, as you can see in the blue box, was at 10. And this seems low for a strong company such as Verizon, but this is just because Verizon's much more leveraged than the other three companies, and that can skew the ratio. AT&T had a PE ratio of 14. T-Mobile's was really high at 47, which can indicate that investors are expecting higher earnings growth in the future. Just to conclude, I showed a picture of a comparison of the four companies on the New York Stock Exchange for common stock over the 5 years. Financial ratios are used to determine the strengths and weaknesses of the company, and I found that strengths of Sprint are their high accounts receivable turnover and the fact that they have more assets than debt. Weaknesses, though, drawn from this is their lack of profit and extremely low market value. The negative earnings is really a killer for Sprint right now, so they want to try to get that in the positive range. Even though Sprint's financials don't seem promising, Sprint has gone through ownership changes. That's going to change a lot of the ratios for the future. Some ratios are already showing improvement from the past years, so that's a good thing, and hopefully moving forward, Sprint's going to be able to make decisions that are going to turn these ratios around.